Hello, everybody. Hello, real estate professionals. Thank you for joining our Agent Advantage monthly webinar series. My name is Kurt Klaus, and today's topic is what are non-QM loans? We do these webinars every month, and we want to not only help you learn, but we want to help give you sources of more business and new business. So we thought this would be a great topic to benefit you, the real estate agent. These webinars are brought to you by our entire Guaranteed Rate family of companies. And today we want to learn about non-QM financing, as an opportunity for new business, how to help you close more deals, sell more homes by helping your buyers that may have maybe a unique income source, help them obtain a loan. You know, your buyers may be qualified buyers, but they might just not fit into the box, the traditional box. So today we want to help you turn those no's into yeses. And these are all brought to you by the Agent Advantage website, agents.rate.com. It's no cost. It's our one spot where you can go, where we have our mortgage tools and our coaching piece like these webinars and some of our marketing help. We also have an Agent Advantage Insider Facebook page. Click that QR code or go to Facebook and just search Agent Advantage Insider. And it's a closed group that is for all of our agent referral partners with all of our companies, and that has what we're doing with Agent Advantage, when the next webinar like this one is, and gives you a forum to talk between each other nationally. So again, our topic and our title today is what are non-QM loans and how they can help you, the realtor. And who better to talk about it is our EVP Head of Product, Kate Amore, with the entire Rate family of companies. Kate is great with joining us every once in a while to talk about what's going on product-wise. There you can see her background. I won't pump you up too much, Kate, but we really appreciate your time and helping get into the details of the products and exactly how they can help real estate agents. So I will turn it over to you and let's learn about the world of non-QM.
Yeah.
Oh, by the way, everyone, please ask your questions. We do these live for a reason. So in the chat feature of the GoToWebinar, type your questions in there. And if we can at the end, we'll save a few minutes to ask your questions to Kate. So please use that chat feature on the GoToWebinar. Sorry, Kate, I'll turn it over to you.
All good. So I am thrilled to be here. We're going to be covering off on product overview, non-QM loans, what's the market opportunity, and then selling non-QM loans. I'm going to go off camera so that you can enjoy our awesome presentation that we've put together. And I'm absolutely thrilled to be talking to you about one of my favorite products and programs, non-QM. All right, so let's talk about non-QM, why you should care, and why it matters. So when you're thinking about who you're doing business with and what companies that you choose to partner with, being able to say yes to all of the different clients that you run into is an awesome opportunity because it helps you do what you do best, which is sell more homes. And one of the things that we pride ourselves at our Rate family of companies is really making sure that we have all of the different products and programs that allow you to say yes to every customer that could come in the door. I always like to joke around with our salespeople that we've got a loan for that, and the reality is we do. We do. And by the end of this presentation, I think you're going to really appreciate one of the top programs that we happen to do here at Rate, and that is our non-QM product. So let's move to the next slide and talk about, well, what is non-QM? And for everyone who doesn't realize this, I have to say, like, 10% of all of our business last month was non-QM. So we do a lot of non-QM, and we have industry-leading pricing in this area. And what is really a non-QM mortgage? Well, I know that non-QM has had a bad reputation over the years, and people think it is a light doc or a no doc loan. And I'm here to tell you that is not the case. Non-QM just simply means that it doesn't meet the CFPB requirements for a qualified mortgage, which is really a points and fees argument. It really doesn't have to do with paperwork these days, although you'll find a lot of flexibility regarding paperwork options within these products and programs. And we're going to talk about the different type of customers and clients that let you help. So why should you care about non-QM? Well, there is an awesome market opportunity with non-QM. Non-QM is financing beyond the traditional W-2 financing that you see so well supported by so many different banks and IMBs just like us. It's for additional opportunities to qualify self-employed borrowers. And as you can see, gig workers, for example, are self-employed borrowers, and they are 36% of the workforce, and that's expanding 3 times faster than other areas in the United States. And there are over 16 million self-employed borrowers and 33 million small businesses. And non-QM was the product that was designed just for that subset. There are also amazing opportunities to finance investment properties in non-QM. And why would we care about that? Well, guess what? 26% of all purchase transactions were for investment properties. And I know that there's a lot of fake news out there that says that it's all going to giant institutional lenders, but everybody knows that's not true. Most of it is small investors that own anywhere from 3 to 9 properties. That's 47%, and 36% are going to be the 10 plus. And one of the things that I love about being here at Rate is we also offer residential commercial. So we are able to finance everything, whether you're looking to buy your first rental property or your 50th. All right, so let's flip over to the next slide and talk about some of the exciting aspects of where we're going. So how do you identify somebody who maybe isn't going to fit a traditional mortgage? Well, typically these people are self-employed. They have CPAs that love to write down their income. Maybe they're freelancers, or they have non-traditional, or sometimes what I like to call lumpy income sources. Sometimes even realtors can be a great fit for this program because you may be 1099. Maybe you like to write off your income. And maybe your income, maybe you sell fancy homes and your income comes in lumps and bumps. And not every investor or lender appreciates how to qualify people with non-traditional sources of income. We here pride ourselves in having options that are going to allow you to say yes, be able to increase your purchasing power, and get that dream home you've been thinking about or that your customer would like. And we have many different documentation requirements that are going to help make that happen. We can either do it in what we would call an old school full doc loan. We've got alt doc, meaning we're going to use alternative documentation to help say yes. And we also have programs called debt service coverage ratio programs, which are really cool products that act like a little mini commercial loan where we're going to qualify the borrower based on the cash flow of the property. I mean, that makes sense, right? All right, let's scoot to the next slide. So let's talk about full doc and what would fit there. So the beauty of a full doc loan is it's like a normal traditional jumbo with more expansive abilities. You can have a higher debt to income ratio on it, meaning if you like to write down your income and maybe you don't qualify at a local bank that's super conservative, or you have a borrower who's not qualifying, guess what? We're going to be able to make that happen for you with one of our awesome non-QM products, because non-QM is going to allow us to find more income that we're going to be able to say yes for. Maybe we have a need for some type of flexibility around property requirements, such as non-warrantable condos, condo-tels. Maybe it's a complicated co-op. Maybe there is a requirement where a borrower wants to buy a house before they sell their existing residence. Guess what? We got a loan for that. Or it's a complex or unusual business income scenario where maybe there is a property developer and they're getting a lot of they get paid in one giant chunk a year, right? And then they like to write it all down. And that could be complicated. You just don't know, right? So where are you going to find these people? Well, they're definitely going to be people who come to you and are self-employed. You know that. They have all kinds of businesses. They are your small business owners. They could be Main Street American business owners, or they could own fancy businesses. It doesn't really matter. Non-QM has an opportunity to make financing available for everyone. So if you're an accountant, you know accountants who like to write down income, or you have a borrower who's been told they will not qualify for traditional financing because they write down too much income or they don't claim enough income for tax purposes, guess what? We've got a scenario that's going to help say yes. So let's move into the next slide where we're going to talk about alt-doc loans. So alt-doc loans are probably one of my favorite areas in non-QM because this is where the magic happens. And we have programs like bank statement loans. Now, this is a common sense loan if I've ever heard of one. We're going to qualify a borrower. See, everybody thinks these are like stated income, and this isn't. We're going to qualify you based on the deposits going into your business bank account, real cash coming in to your business bank account. And we're going to be able to qualify you based on that business cash flow. Now, if that's not common sense underwriting, I don't know what is. We also have additional programs that are going to allow people to qualify with either 1 year of tax returns or 1 year of W-2, which is a really great program, especially if somebody's had a bad year or if they're newer employed and they're ramping up. We also have programs that are called 1099 programs. Now, I know many people who have 1099 jobs, but they're maybe an emergency room doctor, or maybe they're an engineer somewhere, or have some type of role that you would largely consider to be a normal W-2 job, but it's not. It's 1099. And guess what? You like to write down that income. I don't blame you. Who wants to pay taxes? Most people do not. Okay. And in all fairness, we got a loan that's going to make it easy for you to have the best of both worlds. Not pay those taxes and still be able to get the dream home you want. Now, that is a match made in heaven. We also have amazing asset programs, and these asset programs provide a variety of qualification tools. So if you have a lot of assets sitting somewhere, maybe you have a lot of retirement income, or you just have been saving, right? We're going to be able to use those assets as income for the loan and make it easy for you to say yes. We also have P&L programs, which again, just common sense underwriting, and we have ITIN programs as well, which will allow self-employed borrowers with international tax IDs get loans, which I absolutely love. All right, let's cruise. So where do we find alt-doc borrowers? I think there's a lot of great places and spaces to find alt-doc borrowers. They're typically self-employed, attorneys, CPAs, insurance agents, small businesses. For 1099, just think contractors, healthcare, freelancers, gig economy, multiple income streams, or maybe you're a retiree or an investor. Any one of these future home buyers could be an awesome opportunity for us to be able to say yes to this. So when one company says no, just remember there's another place that's going to say yes, and we are that place, and we have those products. We have all of those products. So when you're thinking, where am I going to find these borrowers? Where am I going to find these future homeowners? And who is going to do the financing? You know, we've got a loan for that, guys. We've got a loan for that. All right, let's cruise on to the next slide. Multiple income sources. So let's talk about how this works. What if I have a future home buyer and one of them works at a traditional job and gets regular W-2 wages? And then the other person's self-employed. What are we going to do with that? Does that, I don't know where to go. Well, guess what? We've got a loan for that, and it's non-QM. We're going to be able to allow one borrower to qualify based on their bank statement income, and the other borrower that maybe has a normal W-2 job is still going to qualify based on that traditional income flow. Where else could you take a complex income scenario that in the past that self-employed borrower would have made that entire deal fall apart? And now we're going to be able to do common sense underwriting, take the cash flow from that business, be able to create a common sense income qualification requirement, and then pair that with normal W-2 income. So just remember, there's lots of different ways to be able to do common sense underwriting here with non-QM, and we pride ourselves in being able to offer this to our realtor partners, so you know when you come in to rate and you get one of our pre-quals, it's always going to be a way for us to say yes. And guess what? If something changes, or if you have a complex borrower, we're going to be able to do all those deals. We're going to be able to do it on cutting edge technology and with the speed and delivery that you've grown accustomed to as something that really sets us apart. And that is one of the things I love about being here, is how we're able to set ourselves apart with that. All right, let's go to that next slide and talk about multiple income sources. So I love to talk about DSCR because I think property investors are just the gift that keeps on giving. Like when we sit and think through who do you want as a home buyer, I always think property investors are the best, because you know what? Not only are they going to buy multiple houses from you, right? They're going to buy multiple houses. Maybe they're going to sell houses. They're going to flip them. They're just industrious people who like to make money, and I'm into that, right? I think that's amazing. And I think it's awesome that we've got a special product that supports those people. So who is the perfect person? Like, I know it, you know, typically you could qualify for Fannie or Freddie loan if you've got under 10 finance properties, but the reality is there's a lot of loan level pricing adjustments these days on those loans, and the rates are pretty high. And the beauty of it is non-QM has a different opinion about that. And not only does non-QM have better rates oftentimes, but we have programs like the debt service coverage ratio program that allows somebody who specializes in property investment to qualify without using their personal income, because we're looking at it as a business purpose loan, and we're going to let that fund in an LLC. We're going to be able to leverage the portfolio of investment properties, and we're going to be able to use the cash flow off of the individual property to qualify the borrower. So as long as the property has a positive cash flow, we're going to be in the money to do that at, like, wow, such an amazing rate. And the beauty of this is that these customers come back again and again, right? A lot of them love that BRRRR method, buy, rent, renovate, repeat, right? And so where are we going to find these people? Well, you know, I think there's lots of great places to find them. And if our amazing realtor partners are referring them over, I love that. But if you're a realtor thinking, where am I going to find more of these people? Because everyone wants a property investor in their back pocket. They're perennial buyers. I always think a good spot to look is social media, right? And then there's also financial advisors. They know who owns a bunch of rental properties. Property management companies are a good place to get in touch. And there's lots of webinars and local seminars that specialize in supporting these different folks. So this is definitely in a place and a space that you're going to want to check out. Now, you're going to love this, because a debt service coverage ratio program is practically, you know, it is one of the easiest loans you're going to do. And it's something that's going to get done quickly, fast, and with minimal to no paperwork. Again, we're not asking for tax returns, and we're going to qualify the borrower based on the cash flow of the property. So we're going to take average gross income for the property, and we're going to divide that by the PITIA, or property insurance taxes, insurance, and assessments. And that's going to equal our debt service coverage ratio. So as you can see, if the income from the property, which is your rent, covers the payment, taxes, insurance, and any assessments, you've got an awesome investment that's positively cash flowing. And then in some markets, maybe you're buying it for HPA, home price appreciation, and we have great solutions for that as well. So when you're thinking about where to find financing for a property investor who offers residential commercial, who is going to be able to do loans that are not looking at regular borrower income, allow for financing in an LLC, we've got a loan for that. In fact, we have many loans for that, and we have industry leading pricing, and we're doing it on the best tech that is out there. So DSCR is that product, it is that program, and personally, it's my favorite because we can get decisions out in days. It's amazing. All right, guys, let's move to the next slide. So let's talk about some of my other favorite non-QM features, because I would be remiss if I didn't talk about other ways that we can say yes with industry leading interest only. We have 40-year terms, buy downs, and one of my favorites in this market, prepayment penalties. So why should you care about this? Well, we can offer borrowers lower monthly payments with features like this. And these features mean it increases purchasing power. If you've got a borrower's like, I have priced out of the market, I can't afford the payment, I don't like the payment's making me nervous, we've got features and programs that help solve for it. It also improves property cash flow. So in many instances, if you're running a business, things like this can actually improve the cash flow of the overall property and help for qualification purposes. So let's dive in to some of my favorite programs here. All right, so 40-year and 40-year interest only. I like to think of 40-year as a way of offering affordability to a jumbo or non-QM borrower. So I want to point out to everybody, and this may be actually very surprising, but 40-year IO pricing is practically on top of a 30-year these days. In fact, it's very similar. And mind you, I know the market has sold off this afternoon and pricing is improved. So just bear with me as these are examples. But at the end of the day, if you have somebody that's already going to be in one of these non-QM products or programs, we offer these 40-year programs. And as you can see, if a borrower selects the additional 10-year amortization type, the monthly savings is like $567 a month. Like if you add in the IO feature, I mean, that's just insane. That's like a fancy car payment right there. And you wouldn't think that, and the rate's almost identical to where you'd be on the 30-year. I mean, if that doesn't increase purchasing power, I don't know what is. And it's going to save the borrower $6,800 a year. A year, guys. A year. And so these are just different ways that we're coming up with clever options to really help people buy more homes. And this is the time and place when housing affordability is an all-time issue, and having great resources like this can really be a deal saver, or could help get that home buyer to think about, maybe I will buy that house. I think I'll go for that. So 40-year and 40-year interest only are amazing options. Now let's go to my next favorite and talk about buy downs. So here at Rate, we offer a whole suite of buy downs. We have our buy down program that allows our realtor partners to advertise below discounted rates, which are amazing, that you're definitely going to want to check out. We also have permanent and temporary buy downs. And we offer temporary buy downs on all of our non-QM products, which are positively amazing. And in these examples here, I'm going to show you how a normal buy down compares to a 5% rate reduction. So if you've got a property that's been sitting there a couple months, which I know as we're heading into the election, that could be a distinct possibility, and you're saying, well, I could do a 5% price reduction, or you could do a buy down and help that property move. So if you did a 5% price reduction, the possible monthly savings on that to the borrower are going to end up being $353.90 a month in the example of my $1.2 million property. All right. And in this deal, we've really decreased the price by quite a bit, right? And you're only gaining $353. Now, if you agreed to do a seller concession toward a buy down and you just did it for 2%, which is only going to be $16,000, which is way less amount of money than that 5% price reduction, you're going to save the borrower $757.26 a month for the life of the loan. The entire life of the loan. Whoa, right? I mean, that's pretty freaking amazing. Now, let's say you're feeling generous and you really want to move this property. It's been sitting there a minute. You do a 5% buy down. All right. Listen, at $40,000, it's still way less than the 5% price reduction. It's still less money. Everybody walks away from this transaction with more money. And the borrower saves $1,321.38 a month for the life of the loan, guys. That's a huge savings on that $40,000 seller contribution. And that's a huge benefit to increasing purchasing power. All that and buying that rate down. And let's be honest, with where rates are today, with that buy down at a 5.6, even if the market sells off and we get into a possible refi environment in the spring, which we've been talking about for years, it hasn't happened yet. The reality is that that rate's low enough that borrower is going to love that and they're not going to care and want to refinance. So you're setting people up for success. And just think, you can offer these amazing features on our kick-ass non-QM products, guys. We offer all of these. All right, now let's move to my favorite other strategy here on the next slide, prepayment penalties. Now, before you tell me prepayment penalty is a dirty word and it is bad, I want to tell you all that 73% of all investment property loans are closing with prepayment penalty. There's like over 1 billion of it sitting in the locked pipelines and the Optimal Blue reports. There is a ton of it. And why? Let me tell you why. Prepayment penalty offers below market rates for the life of the loan if the buyer just agrees not to prepay the loan in the immediate future. And you can select the prepayment penalty term. And when you combined it with a seller paid buy down and discount points, you're going to get the borrower in a below market rate that they wouldn't be able to get in the future upcoming refinance anyway. It is huge money savings, and it allows your property investors to increase their purchasing power, get better rates, and be able to buy another house from you sooner because we were able to lock them into that awesome, better interest rate. This program is an absolute no-brainer. And it is something that is going to be hugely helpful in getting people to say yes and able to buy more homes. It absolutely is an amazing feature and something that is so misunderstood and misunderutilized in our industry. So one of the beauties of this awesome feature is that we have this available on every doc type for property investors only, and make this widely available. So it is really, truly a business purpose loan. And yes, we do have 40-year terms with prepayment penalties. All right, so let's bring this on home. We're at the top of 30 minutes here, and I appreciate this opportunity to be able to talk to everybody about all of the cool products and programs that we offer here at Rate in our non-QM product lines. And I would like to open this up to some questions. So What have
Thank,
we got going on?
yeah, let's sift through and see if Mike can come on and ask a question. But yeah, Kate, great stuff. Not only the specific details, but how you can source, business and find people that are in this situation. My takeaway was, thought it was unique income sources, unique properties, but in today's world where everyone or a lot of people may have a second or a third job, those unique income sources are probably more common than you think.
Agreed. There are way more of these loans getting done than most people realize. And previously, we used to have to turn these people down and say no to them. And now we're able to say yes. And one of the beauties of being at and working with Rate is that we have industry leading pricing on these features as well as the ability to combine them with different features and programs like buy downs or prepayment penalties or 40-year terms, that we can create a custom solution for any borrower based on their need in order to create that affordability option that they're looking for, which is really a game changer in terms of housing affordability and being able to say yes to today's complex borrowers. The reality is most people don't live in a place where they have a single wage earner making W-2 income. And most people have complex scenarios with multiple jobs, multiple income streams, and that's just the way that it is these days. And so it's really great to be able to say yes to those borrowers.
Awesome. Kids, are there any other, do we have any other questions you've vetted out, Mike, that we can bring up here, or are we good? I see a lot of them were answered in the chat.
Yeah, I did want to bring something up, and maybe Kate can address it. And this is something that we hear often. So, given the market today, Kate, right, with where we're at and uncertainty, how does one kind of position and sell a prepayment penalty when the mindset in general is that rates are likely to go down at some point in the future here? Maybe you can kind of speak to that a little bit and give a little color around that.
Yeah, so, the Fed has lowered rates multiple times this year. And the reality is that the market prices in the lower rates months in advance of those rates going down. So as everyone saw, the last time the Fed, air quote, lowered rates, the market actually increased rates because there were foreign events going on that impact oil prices. So the reality is that anytime the Fed says they're going to lower rates, the market takes action on that months in advance. So any rate changes that are going to be happening later this year or early next year are already being priced into the rates that you're seeing today. Now, mind you, we just had an election, so there's some additional sell-off and pricing things happening. But the reality is these things increase and happen months in advance. So if you're waiting until the day that the Fed makes an announcement to see a change in rates, you've already missed the opportunity because it already got priced in well in advance of that opportunity. And then I would also say to you that prepayment penalties, when combined with discount points, offer rates below what the borrower will ever be able to qualify for without one. In fact, the rates are so low that it's really doing someone a disservice not to offer it. And the majority of loans are getting structured in this way and closed in this way. So not offering something like that to a borrower is really doing them a disservice because we're not offering them the best pricing that could possibly be available. And so I do think it's important to make these features and programs be available to people and let them choose what makes the most sense for them. But like I said, we've been waiting for the market to sell off and for the refi wave to come for years. And the reality is that, rates are probably gonna be higher. And so take advantage of these features in order to close deals today at the best rate possible for your client and be able to laugh all the way to the bank because they're going to be in a better spot, you're going to be in a better spot, and they're going to come back to you and be able to buy more houses because they have more purchasing power because they got a better payment. That's just the reality. It's an awesome product when used appropriately. All right, Mike, what else we got?
A couple questions in here. It says, when you say commercial, does that mean strip centers and buildings are residential commercial only?
We currently offer residential commercial financing. So if you've got 5+ units, mixed use, a combination of possible like storefront with residential properties above it, all of those different types of programs we're going to be able to offer today.
Okay. And then there were a couple different slide specific questions in here. Not sure entirely how you would address them.
Okay. I do see a good question in here about figuring out whether or not a loan should go for conventional government and FHA. And I would say to you guys that here at Rate, we offer, industry leading government pricing. We have industry leading conventional pricing. And now we've become a leader in these non-QM products. And so these programs, generally speaking, are going to be the best fit for somebody who doesn't qualify for traditional financing. But it is also true that sometimes the rates on a non-QM product are actually better than traditional financing because the non-QM market maybe has a better opinion of the credit risk associated with that and is just willing to offer a more competitive rate. So sometimes you will see a borrower that you would have thought would have ended up in a conventional loan, end up in a non-QM loan because the loan level pricing adjustments, which are what goes into interest rates, are better and more advantageous in the particular product or program. And so this is a good conversation to have with your loan officer. Your loan officer is going to do a consultative sales process with your home buyer and help them find the best product for them. I like to think of it like Harry Potter when they put the hat on and the hat sitting over the borrower thinking like, okay, I'm going to go through all these different things and figure out which one of these products are. That's what our loan officers are like. They're sitting there, they're talking with the customer, they're thinking through like what are all the different scenarios factoring in here, and then selecting the best product or program for them. Now, sometimes something will come up within that process. The borrower won't work in that particular program. And the beauty is we have this full suite of solutions to continue to find a way to say yes to you. Most companies don't have that kind of certainty, but we're going to be able to get deals done that other people are not simply because we have all these options. All right, Mike, anything else?
Sure, a couple just hit right now. How do you determine the investment property gross income? Is it based on market comparison? From Larry.
So there's going to be two ways that we're going to figure out the gross income on the property. We're either going to use an executed lease or we're going to use the information that comes back from the property appraiser when we order the appraisal through the third-party solution that we have to get it from. All right, anything else, Mike?
One last one here. When listing condos, how does a listing agent determine if the complex fits the criteria for a non-warrantable condo?
Ooh, I love that question. And I think this is a great opportunity to work with one of the amazing Rate loan officers because they're going to be able to pre-flight that condo with our condo desk and tell you if this is a condo that's going to meet agency requirements. So you know whether or not it's warrantable or non-warrantable. Because as we all know, warrantable condos are easier to sell and sell for higher prices than non-warrantables. So work with your loan officer. We have a process set up just to support this, to make sure that you're getting the best experience possible.
Okay.
All right.
Very good. Yeah. Thanks.
Perfect.
Thanks, Mike. Thanks, Kate. Lots of great questions, great engagement here. I saw some also on the buy downs, and I will tell everyone on the call that this webinar will be recorded and sent out to all who have registered. It will also be archived and placed on the Agent Advantage coaching tab, agents.rate.com. Just go to coaching, no login required. Kate also did earlier in the year an entire webinar on buy down if you want to hear a whole full webinar on the rate reduced sell. So all of our webinars are archived there. This one will be. Kate, if you don't have anything else, I can't thank you enough. Great as always. Appreciate your time.
It was a pleasure to be here. Thank you for having me.
Love it. And thanks to all who attended for jumping on our webinar. Hope you attend one in the future. We usually do these the first Wednesday of each month. Thanks again. Have a great rest of your day.